Mark, good to see you. Today we are talking recession-proof investing, 4 strategies for navigating market volatility. We've all been hearing a lot of scary headlines about the markets lately. What's going on?
Well, Aaron, it's great to see you, and thank you so much. So, yeah, these are really interesting times, and it's in times like this of all this uncertainty. So, again, we've got tariffs and this uncertainty around that. We've got the potential for inflation or deflation. I mean,
Mm,
every single day, the conversation that's coming out seems to be changing. But really, the bottom line is we really need to step back from that noise and really understand that, hey, yeah, maybe we need to revisit things with our plan, but really it's sticking with the plan if it's going to meet our goals and objectives.
mhm.
That's really the bottom line because we can't control this. So we have to step back and go, okay, what variables can we control? And how do we navigate through this uncertainty? Because nobody likes uncertainty. It creates emotions that really take us to places we don't want to be, but these are just cycles that we have to go through. So really come back, revisit where you're at. If your plan is still intact, it's on track, then you know that you're okay. Yeah, you might emotionally be uneasy for a little
Yeah,
while, but ultimately we're going to get through this.
right. Well said. Let's talk through some common questions, though. A lot of people think cash is king during recessions. Are you recommending people allocate a larger portion of their portfolio to cash right now?
Yeah, Aaron, not necessarily. In fact, in our practice, we like to say instead of cash is king, we say cash flow is king. Because again, if we're creating income in retirement or we're positioning money for that, that's exactly what the name of the game is cash flow. So yeah, maybe somebody needs to allocate more to cash, but this may not be the best time to do that. But again, it goes back to plan objectives, goals, and understanding where you're at relative to what the economic environment is. Now, some people, yeah, they may feel comfortable allocating out of some positions that are in the market back to cash, but we don't want to overemphasize that. For most people, that's not going to make any sense.
Mhm. So, how about defensive stocks, healthcare, utilities, food and beverages? I mean, we all still get sick and we all need to eat, right?
Yeah, you're absolutely right. I mean, whether the economy's good or bad, I mean, if the economy's bad, maybe people drink and smoke more because they're stressed out and
Yeah.
they craft macaroni and cheese. But again, these types of stocks should be already part of somebody's portfolio, especially as they're nearing retirement or already in retirement, because yes, they are defensive. They pay a dividend. They have consistent cash flows. So if we're not there, this may be an opportunity to allocating a percentage of our portfolio to those types of companies.
Hmm. And how do you feel about dividend stocks or other fixed income investments like bonds?
Yeah, so I think this is another area. The answer is it depends, and it depends on where the client is in their cycle. But again,
Mm,
if we're talking about a pre-retiree or somebody that's already retired, yes, this should be a component of their portfolio. Now, how much depends because everybody's a little unique in this respect. But yeah, high dividend paying stocks, especially now with uncertain times, create some stability in the portfolio. Same with fixed income, because yes, if rates are coming down, we've captured some yield or income from those higher rates. And then ultimately, as rates come down, we're capturing gain in that fixed income portfolio.
makes sense. Last, even during downturns or especially during downturns, keep investing. This is known as dollar cost averaging.
Yeah, and this is especially true for people that are continuing to work. That because you got to pay the plan, and then we've seen it time and time again. People that pay the plan, especially in times like this, you have to remember things are on sale to some degree because they're lower than what they were a month ago or 2 months ago. So you're getting things on sale. You're buying more shares. Now, if we're not saving anymore, what do we want to do? Well, we may have cash on hand. We've got some powder. I call it keeping our powder dry. That we may want to at some point take some of that capital that's been not affected by the market and reinvest it when prices are much lower. But obviously we have to be considerate about where that money goes within that portfolio.
Right. And this just all comes back to what you say all the time, which is the importance of having a plan so that we are not reacting emotionally to these scary headlines.
Yeah, exactly. I mean, because again, the plan is what's going to lead us down the path. I mean, we have to get that right on the front end, and ultimately, yeah, we can make some tweaks, and we have to rebalance things or revisit things. But we don't have to throw the baby out with the bathwater. And a lot of people that don't have a plan are going to make emotional knee jerk reactions that are really going to be costly for them down the road.
Right. Well, Mark, I'm glad we got a chance to talk this through because I think a lot of people are feeling uneasy right now. So if they would like to talk through creating a financial plan, or if they want a second opinion on the plan they have now, what's the best way to reach you?
Yeah, so the best way to reach us is just give us a call, 303 Or if you'd like, go to our website. We got a lot of good resources there. But I also have a link to my calendar, and you can
Mhm.
set up a phone call, Zoom call, even an in-person appointment. We'd love to chat with you about, hey, let's get a second opinion on this. Let's re-stress test our plan. And if we don't have a plan, obviously we want to help you put that plan together.
Great. Mark, thank you.
All right. Thank you, Aaron.